The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
All right, welcome back to another edition of the Daily Dots. Here on Tuesday, July 8th. Chase riding solo with you today. I think I'll be with you again tomorrow, and then probably Zach Thursday, Friday. This one will be very short, not a whole lot to cover. So this is going to be definitely a summer episode. But I'll hit the markets, and then I'll talk a little about data and news and what some of that might mean, and then just sort of my updated view on the markets as a whole. Today was very, very boring on the indexes. You had S&P flat, essentially Qs flat. Because I made fun of small caps yesterday, they were up 0.7. Equal weight was up 0.25 with Mag 7 down about 0.07. All world ex-US outperformed today at 0.6. Dollar, let's see. Dollar had an interesting day. It kind of had a pretty decent sized range, and then closed pretty flat. So kind of all over the place. Bitcoin still around 109. Oil up about 0.5% and up over $68. That's been frankly stronger than I expected. Something we talked about in our investment meeting today, kind of why. One of my thoughts is just kind of the dollar correlation. As the dollar kind of bottoms here, maybe oil is picking up, gaining some steam on that. You have Russian exports down. That's a little bit helpful. It looks like maybe the U.S. is running out of steam on the production side. But for me, when I kind of zoom out and just think about the barrels aspect, not that that's everything in oil prices, because it's not, but when you just kind of count barrels for where we're heading for the next year, it just seems like there's going to be too much oil. But for now, it's up. I think you're fine as long as you're around here. But if you get back above 80, that's when it becomes a bit of a macro problem because it would be driving some inflation. But my assumption is still that we're kind of flat to down from here. Gold down about 1%, silver flat, platinum palladium up about 1%. The big story of the day, which we'll touch on later, is copper was up 9%. As far as yields went, you're flat on the front, and up like 1-2 basis points out on the long end. You had a little bit of a bounce back from Tesla today, Apple flat, Google down a little over 1, Microsoft basically flat. Vol notably compressed today. You had front month VIX futures down 3.8%. So you're almost back down to 17 handle. That was somewhat notable to me, especially given the kind of the backdrop, especially the backdrop that I talked about yesterday. You had NVIDIA up over 1. So even within Mag 7, it was kind of a bit of a snoozer. With that said, we had some data today, which, matter of fact, I'm not caught up on. So I'm in real time. No, I won't. This is not pulled up. I did look at the small business survey to get a feel for where that's at. It was basically unchanged, hasn't really moved, exactly where I was expected to be. But when you go inside of it, sales are suddenly becoming a problem. It's sales so in the survey, there's all these things. It's like, which one of these is your biggest problem? And they kind of just, move all over the place. Sales is its highest proportion of being a problem, if you will, since 2020. That's a little bit concerning. And then the employment metric in there was pretty ugly for the month. So there was some red flags inside of it, but then there was some other stuff that wasn't that bad. Prices continue to look like they're going to pull inflation higher whenever you look at it. It has actually a really good track record long term of tracking inflation, and now that's broken. Inflation is pretty low, and what they're expecting from small businesses is pretty high for prices. So that gets kind of interesting to see how that divergence ends up squaring up. Um, so kind of a mixed report from the small business survey from NFIB, but there definitely was a couple of things that a little more concerning than normal. Um, Obviously, yesterday the big news I covered was all of the country tariffs. Today we got another sector tariff, and that was on copper at 50%, 50. That's why copper was up 10% on the day, which is a huge move for a global commodity in one day. This will be interesting. The U.S. Is a pretty significant net importer of refined copper, and not only that, but doesn't even come close to covering all of our own copper production. Obviously, tariffs get put in place to try to build that capacity out. So the hope is you get more mining, maybe more smelting, processing, and I think it, can absolutely work to bring that about over time. But do you need 50% instantly to get that? I don't know, because you can't build a smelter overnight, and you certainly can't build a copper mine overnight. These things take 3 to 12 years usually. So you're talking about an interesting dichotomy there. And speaking of interesting, so you have the copper price. I mean, it's up at like 15% at one point one day during the day, closed up 9. But copper miners as a group closed up less than 1%. And the other interesting thing today was, you had oil up a little, but then you had energy stocks up a lot, and then kind of the same thing for on the opposite end, where you had gold down a little, but you had gold stocks down a lot. So gold miners were down about 4.5%, and I'll just pull up the XLE, even though it's not my favorite. XLE was up like 2.7%. We'll see what XOP was. XOP up basically 2%. That's the producers. OIH, which is the oil services company, is up almost 5% on the day. So, oil up a little bit, but oil stocks up huge, and then gold down a little bit. Gold stocks down huge. It was just, I don't know. That was just an interesting day. I don't even know what to subscribe that to, unless some whale had a big pairs trade on between that two, and they just unwound it. I got nothing. And maybe something hit the news today along these lines that I just missed, but I found that somewhat interesting. As far as the macro impacts of the copper move, I do see this as because we cannot domestically take care of all that. There's going to that is demand that's not super flexible. The buildings we need to build are going to get built. The cars we need to build are going to get built. Like the energy infrastructure we need to get built is going to get built, especially all the stuff currently, being built and late stage planning. So that means people are just going to pay more for the copper inputs into these projects, which I would say, by its very nature is just going to be inflationary. Now, does the copper tariff have to be enough to move, realize inflation up a lot? No, not at all. But, 0.1, 0.2, 0.3, whenever you start looking at all these different tariffs, if they all kind of sprinkle in 0.1% inflation here and there, next thing you know, it does add up to being a problem because, the Fed already cannot cut because we're still above 2% inflation before tariff impacts start really being felt. So as they do start to be felt more as we get to late summer and we add on, stuff like this copper tariff, and we still have chips and pharmaceuticals, and there's more things to come as far as sector tariffs go. And obviously there's more to come whenever it comes to country tariffs. We don't know where the EU stands at the moment. We're not really sure where India is going to end up. We're not sure where, even necessarily Korea, Japan, South Africa, et cetera, are going to end up. But what's kind of become clear this week is that there are going to be tariffs, and they're not going to be small, on a lot of countries and a lot of different sectors in the economy, which means the realized effective tariff rate, broadly speaking, for imports into the U.S. is going to be relatively high. It's going to be the highest we've been probably since the 1930s, almost no matter what at this point. I see that as somewhat inflationary, and I see it as somewhat growth inhibiting. If it all ends up staying, pretty close to the highs of these levels, then I see it as recessionary. But there's so much time left between now and it becoming that who knows. And plus, when it comes to is it inflationary, it's obviously inflationary for goods, but it's not obviously inflationary for the whole economy. That still remains to be seen. I still think it will bleed into just measured, consumer prices broadly. But if it starts to hit the economy hard enough to really smash services, housing, etc., then you could almost have like a net effect where it just, like goods inflation is too, but services inflation is so flat that it's not doing enough to matter. That is still very possible. My base case is you still have enough services inflation due to especially wages, which may well bottom soon, to combine with goods inflation that turns into, instead of like 2.1, 2.5 above trend, back more towards 2.5 to 3, well above trend, keeping the Fed from doing a lot of cutting.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate and actual performance may differ.
And speaking of which, I would say that's back in the news, but that's been essentially in the news every day. Another thing we talked about in our investment meeting today, and I've mentioned this on the show before, maybe even twice, because it constantly frustrates me that, and not because laymen think this, but I hear this a lot from professionals where they just keep talking about it as like, oh, well, we're just going to put someone in that will cut rates and then they'll cut rates down to next to nothing. And that will be that. And the reality is the Fed chair is one of 12 votes. The other 11 votes count the same as the Fed chairs. I think because it has been an institution historically has worked so well on building a consensus and always doing its best to listen to the Fed chair and kind of at least let them be a tiebreaker and go with their wishes. Like, I think because it's been that way, we all just sort of have created, some mental shortcuts that, oh, well, if the Fed chair wants something, they get it. But I think if we got into a situation where we had 3% inflation and, the White House is telling them to cut rates, that there's, at least 7 people on the committee that would say, no, thank you. Obviously that could become a nasty political showdown, theoretically. But I think it's important to note, hey, Powell has 10 months left. If inflation's low enough, 3 months from now, he'll cut, not to 1% or whatever, but he'll cut. But if inflation picks back up here, he's probably not going to cut. So that takes you to next May when he leaves and then you install a new person. But if inflation is 3+, is that new person really going to be able to convince the rest of the board to go cutting into 3+% inflation? Especially if, wages have picked back up and become a problem, potentially. My thought there is no. But that's more of a thing you got to kind of take week to week, not try to get too ahead of yourselves to try and, figure out 8 steps ahead how it's all going to play out. But I do think it's worth noting as we get more commentary around Powell yet again. But like I said, he has about 10 months left. My current guess is he cuts 1 or 2 more times by 25 basis points in that time frame. Though I am very open to tariff inflation freezing them and him not being able to cut again for the rest of his time there. But we'll see. Long way to go on that. Like I've said before, not a whole lot of data the rest of the week, so expect another short episode tomorrow, most likely, unless something really interesting comes across that I end up talking about for too long. But other than that, I think it'll be another short one tomorrow, and then I think Zach will probably be with you guys on Thursday and Friday, as we're both been kind of in and out of the office busy with some other things. So we'll see. But that's it for me today. Don't forget, you can download and subscribe at knowyourriskpodcast.com. Go watch us on YouTube. Go find us on Instagram. Check us out on TikTok. All the places where the cool kids are, where we are too, which is why we are not on LinkedIn. All right. I'll see y'all tomorrow. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.